Welcome, Curtis. Retire New Stock Market Session 2. How are you?
Hey, I'm doing great. Yourself?
Good. I think we're July 20th,
Yeah.
2024. So while we're on session 2, you had a couple positions you wanted to look at. Tesla, NVIDIA, and GameStop.
That's correct.
We're gonna cover those. Um, I wanted to make sure we review every session between sessions, and I want you to bring questions.
Okay.
So that way you don't miss out on anything. If you have a question, want to knock that out so you're 100% on the same page.
Yep.
All right. We talked about last session on the 11 criteria to stock selection,
Correct.
which is to say that we're using all the right ingredients. The way I teach it, if you want to bake a cake, you gotta have ingredients. Okay.
Yep.
We need to have sugar in the right amount. We need to have flour. We need to have butter. You know, if you don't have butter, that's gonna be a dry cake.
Yeah.
So when we're doing investing, we're using certain ingredients in the right amounts to get the right result. And when we put all the ingredients in and you apply everything correctly, you're gonna have profits. You have the result that you want.
Yep.
That's how I teach it. Okay, so one of the ingredients is stock selection. We're not just gonna invest in any willy-nilly stock. We have, let's say, strict criteria. We're doing accounting. We're like doing accounting on our own books. Like we know where we are. We know, if we're in margin, if what positions are options, what are stocks, what are dividends. We're going to talk about a portfolio. You know what a portfolio is?
Yes.
Which is just to say that we're going to have like a position. Let's say you have an account, right? Let's say one account. You're going to have a portion to, let's say, for example, dividends. One portion, for example, covered calls. And one portion, for example, trading. Does it make sense?
Yes.
Options,
So
let's say options and trading.
yes. So a question, is it typically advantageous for you to have these different portfolios and different accounts so that this is my account for covered calls, this is my account for dividends, this is my account for trading, or does it really not matter?
Yes. We're going to talk about that as we go. For
Okay.
example, we should all have an IRA, for example.
Yes.
You have an IRA where it's going to be for your retirement.
Yes.
So, like for the IRA account, I want you to do mostly stocks, dividends, very light trading. Because why? Because this is like what I call sacred money.
Okay.
I don't want you to put that at risk. If you're doing options, that's obviously you put that money at risk. You can do options in your personal account or your business account.
Yes.
So what I have a personal account, business account, and then IRA. And personal account, I do more high risk trading, whereas a business account is more longer term, monthly, yearly, and then finally the IRA account is very long term, less risk, low trading. I'm doing some light cover calls, and
Hmm.
I'm doing long term stocks, and I'm looking at share growth, dividends.
Okay.
Now, you don't got to copy that right away, but that's how I do it. We can
Yep.
do everything for our purposes. We can do everything in one account, but it needs to be like a balanced account. I don't want to have your whole account options
Yeah.
because we're looking at the account like we're managing the money properly. Um, whether you put everything in one account or three accounts, I don't want you to put so much risk where you can have a big drawdown and
Yeah.
lose a lot of money no matter what. And what I mean by drawdown,
You're asking me?
drawdown is just um, like what your drawdown is per account. is like how much you can lose, like on a
Yeah.
bad day. Think of it that way. I do a
Yeah.
lot of like layman terms, definitions, because I think the definitions in like Google and when you go to these seminars and I think they're problematic because they're not actually conducive to the person learning and making money. They're like more confusing.
Okay.
For
Fair enough.
example, let's do we did drawdown, right? You got the drawdown?
Yeah. You asked me to write it down. I got it.
Yeah, so like let's do options, right? Options. Definition.
Yeah.
It's not the right to buy a stock. You might have looked that up. You might have heard that somewhere. Options is how you control a stock with less money, but more risk reward. Okay. How you control a stock with less money, more risk reward. Why? Because we use it's a derivative, which is to say that it's a tool to trade to control the stock, like a derivative. But it's also on its own, you can trade it, buy and sell. You don't have to, for example, exercise the option. So in essence, it's just a way to control the stock with less money and more risk reward. And one contract indicates 100 shares of stock.
Yep.
And with one contract, the idea is that instead of buying 100 shares, let's say you use NVIDIA, that's $12,000, $120 a share times 100 is $12,000, but you can buy one call option. Let's say the call option is, let's say $12, right? Well, now that call option will cost you $1,200. So with 10% or less invested, you can control that 100 shares of stock with one contract, one call option, or put,
Yep.
or put.
Yep.
Okay, drawdown options. We talked a little bit about portfolio. About the portfolio, it needs to be balanced. This is the main thing, balance. If you were to have your one account, your main account, and everything was to be, um, let's say in call options, well, that drawdown would be too much, too high, and it'd be too risky. It's not balanced.
Now, real quick, when you say drawdown, and that you can have at risk, aren't you managing that risk?
Yes, but even considering you're managing it, I mean, you went to the bathroom, and there was a stock market crash, or the one stock took a dive because they get sued because that one stock,
I
imploded.
see what you're saying.
You wouldn't, you would have, you don't want to have a big loss anytime
Yeah.
because the big losses are very difficult to recover from.
Yeah.
If you, we can follow the professionals, there's some people that manage big money, $700 million. They manage pension funds, IRAs.
Correct.
People working, they don't know what stocks these people manage. They just have, the pension that they're getting from their job after 40 years, 50 years. So these guys, they have to make money. Their job is to make money. Ideally, they want to beat the market. Well, a lot of them don't beat the market, but ideally want to beat the market, meaning that you want to do better than the Dow Jones or better than the S&P 500. Follow me?
Yep.
And to do that, they're looking at dividends, they're looking at cover calls, they're looking at trading, and they have to control their drawdown because if, let's say, the market corrects or their stocks in there correct, they don't want to have a big loss because those big losses are very difficult to recover from.
Yes.
And at the end of the year, they want to have a positive gain, ideally a great gain, and they get what? They get a bonus. They get to keep their job. They get to make their customers happy, and their investment firm, gets credit for being a successful money-making investment firm.
Yeah.
And if they don't do that, if they don't do those things, and if they lose money, they're going to end up getting fired eventually. And you know, if you look at it like that, like to be a professional, these are individual investors that are just, let's say they're working a job, they're doing stocks on the side, they're doing investing. They make terrible decisions. They don't have the ingredients. They don't have any money management. They don't look at the drawdown, and they get in a position. They can lose a whole position. They can lose half their account or more. Novice mistake. That's not going to happen with us. We're not going to do that. We're not going to put ourselves in a position, even if you're managing. You know, I wanted you to be able to go to breakfast, have a nice breakfast. You know,
Yeah.
in a nice hotel. You don't have to look at your iPhone every 5 minutes or look at your because everything is balanced. You have the ingredients. Your drawdown is controlled. You know, I don't want you to be, you know, stuck watching your computer 24 hours. Your positions need to be working while you're sleeping, basically.
Yeah.
I want you to be on the golf course out there hitting golf. You know,
Fair enough.
knowing that your stocks are doing great. You're in a good position. You have drawdowns controlled. Okay, so let's just put a tentative 1/3. This is just a basic. Okay, 1/3 dividends.
1/3.
1/3 cover calls, and then 1/3 trading, and then options. Does it make sense?
Yeah, I'm writing it down. 1/3 trading.
You can do like 25%, 50%, but 1/3 is just a way to say that we're going to balance it. We're not going to have like everything, you know, in call options, or even if put everything in dividends, it'll be too slow. Put everything in dividends, it's kind of like a slow.
Yeah.
I want to teach you fast because I want you to be able to make enough money monthly to pay your bills to retire to the stock market.
Yep.
And
So
we're talking about
with the cover calls, if they happen to be dividend stocks as well, I should just consider it to be a cover call and not the dividend. That's just an extra bonus.
well, technically you can do both. Sometimes what will happen is you'll be in the cover call, and it'll get assigned, which means the stock will go up.
Yeah.
But we don't want to lose the dividend, right?
Yeah.
So we want to make it so the dividends are mainly for dividends. So you're going to have a dividend stock, let's say like MO, okay,
Okay.
WHF. So you're not focused on the cover call, but you can do a cover call. You're just not focused on it, okay.
I got
And
you.
then the cover call portion is going to be like NVIDIA, you know, Tesla, because you just have a high cover call return.
Yes.
And then the other third, like I said, is going to be trading and options. And ideally, you want to also control that trading to where. One more thing, number 4, hedge.
Hedge.
HE, like a hedgehog.
Hedge. Okay.
HEDGE. I can talk about that now. A hedge is a situation where, you know how we talked about being professional?
Yeah.
They can't afford to lose a lot of money. So what they do, they play both sides of the market.
Yes.
Let's talk about the hedge now. A hedge is basically a small percentage of your account. Okay, let's say 5%. Okay, 5 to 10%. 5 to 10%. That is going to be basically you're going to be short.
Yes.
The idea like of a hedge fund in the original old days was like the idea was that you weren't going to be able to lose a lot of money. You know, just like when someone talks about stocks, oh, I can lose all my money. You know, it's a risk. You know. But the hedge fund was the idea is that you're going to make money whether it's going down or going up, right?
Yes.
So put 5 to 10% short, and then circle the 5% because I'm going to show you something. Okay.
Okay.
On this, you're going to buy in the basic trade. You're going to buy a put. Okay.
Okay.
And let's start with the S&P 500. So SPY put. Now, I use the SPY because SPY is very predictable. Okay.
Yeah.
If the market corrects, the SPY is going down. Period.
Yep.
The market goes up, the SPY is going up. Okay. So on the SPY, write down 9-month put.
9-month put.
Yeah.
And
the
what
theory
this
behind
is
this
the
is
5%?
yeah, 5% of your whole account.
Okay.
So if you have 100K, you put 5K to a hedge.
Gotcha.
Now, the hedge is not designed to make money by itself. Okay. The
Okay.
hedge is designed to protect your other positions. Okay. Because remember, like a mutual fund manager, we don't want to get fired. We don't want to get in a position where we lose a lot of money. If our positions are wrong, or if
Yeah.
the market's going against us, we need to keep our job. We need to survive. Write it down, survive.
Survive.
So that 5% hedge, in a sense, you can kiss it goodbye because generally the market's going to go up, your position is going to do great, and that put's going to go to zero and expire worthless. That's generally like what happens in my experience.
Yes.
Yeah. But here's the thing: it's like fire insurance. We pay the fire insurance just in case, okay? And as a mutual fund manager, you're managing $1 billion. You can't, like, you know that story about the boy who lost $1 billion. You know that
No,
one?
I haven't heard that one.
Back in the day, um, there was a big news article it was in England, London.
Mm-hmm.
There was a young man who lost $1 billion trading one of the biggest firms,
Holy cow.
and he I hear that I'm getting fired, but he didn't control his drawdown. He didn't have a hedge. You know, he went all gung ho, and he was wrong.
Yeah.
We can't afford to do that. I want you to always know that somebody's looking over your shoulder, that you're doing proper trade with write this down, limited risk.
Got it.
So let's do this. Can you pull up the SPY puts for next year? It's July. Do we have, say March? Let's say March 7, 8, 9, 10, 11, 12. 1, 2, 3.
Yeah.
We have April.
Yep. Give me 2 seconds. Let me load up my account.
This is a hedge. We're gonna pull up, let's say around between March, April, and May. Let's say
Okay.
around 9 months. It could be a year, but let's just do 9 months from now. And we're gonna go. We look at a correction, Curtis, like a 30% correction,
Yes.
right? So we're gonna go 30% out of the money, which is to say, I would put if the SPYs are 500, then 30% would be 150, would be 350. So like we're gonna put the options, the puts in this case,
Yeah.
30%, signaling that if we have a correction, then they're going to be in the money at the full correction.
So aren't most major corrections like 20%?
I think it's around 30%.
Oh,
We can
okay.
do 20. It's either 20, 25, or 30, but 30 is a little more. I think it's better.
Just yeah. Gotcha.
You know what? Be ready for 30% correction. Don't like lose it. Like some of these, people are in stocks for so many years that you get a correction, 30%, and they act like like end of the world. I do. Don't you know?
Yeah. It's bound to
So
happen.
what's the SPY at?
All right. I just got it loaded up. So now you wanted SPY SPY charts. All right. Go to
SPY symbol
so
indicates the top 500 companies on the stock
yeah,
market.
yeah, exactly. So between SPY and SPX are the two that I typically trade.
Let's do that SPY.
Yeah, I have SPY's option chain open. What month do you want to go to?
Give me Friday's close.
Friday's close is 548.99.
548. So let's just say if it was 550
Yeah,
times 30%, 548 times 0.3. Or
340.
actually do it times point. we times 0.7 because we're gonna go down to 70% of the price.
Times 70%
548 times 0.7 is what?
is 383.6.
So we're gonna buy the put at 383, and we're gonna go 9 months out. So that's is it April?
383 strike. And
For April?
so let's see. So that will be what month are we in now? 7. So January, February, March, April, somewhere around there.
Let's do April.
Okay. So I have April 17th, April 25th. No, excuse me, April 17th, 2025.
Yes.
Okay.
Give me the bid. Give me the bid. And ask. For the 383.
383. Show all strikes. I have in 385.
Yeah, perfect. 385.
385. The bid.
Put.
Say
Put.
again.
The put.
Puts. 385 puts. The bid is 275 or 2.75.
By what? Ask.
The ask is 2.82.
Okay, so we're gonna pay the 282 ask. So $282 per contract. Okay.
Yeah.
And if we have a 100K account, we want to put 5K into this one position. And
Okay.
how many contracts can we buy if it's $282 contract? How many can we buy with 5,000?
Let's see. Oh, it's 282. So 5,000 divided by 282. So 17 contracts.
17 contracts. 5,000, roughly $5,000. 17 puts for the SPY April 2025, 385.
That's 4805.
Let's do 18. Let's take
Okay.
it over. How much is 18?
18 is $5,087.90.
That's closer. So we got 18 contracts. Now,
Okay.
here's the strategy with the hedge, okay? Like I said, we can't afford to lose a lot of money. Okay. The hedge by itself is not it's not designed to be a winning position by itself. It's designed to protect your long position.
Yes.
Let's say we have a correction. Let's say we have a lot of technology, you're in a lot of technology, and your positions go down. We have a correction, we have a crash, etc. This put will come in. Okay.
Mhm.
It'll go up in value. Okay. Now, when this put goes up in value, your other positions will be going down. Okay. But what it is, this put's gonna reduce your chances of losing overall. Okay.
Okay.
Because in the case that we do go down, your positions do go down, you have a correction, you have a loss on your other positions. But this put's gonna come in. And we have a healthy leverage. Since we're going 30% down, we have a healthy leverage to where when we get a nice return, it's not going to cover your whole account, but it's going to be like if you're a professional money manager and you're trading $1 billion, for example, this is where it makes more sense.
Mhm.
If you have a 30% loss, that's 300. How much is that? 30% loss of $1 billion.
Of a million or a billion?
$1 billion.
Yeah. So a million would be, excuse me, a billion would be a 10%. That would be 100 million. So it's 300 million.
Right. So what the put will do, it'll make that like 20%. It'll make like a 20% loss instead of a 30% loss.
Mm-hmm.
And that's a huge, huge difference, Curtis. Huge difference, Curtis. Huge.
Yeah. But
Because
you
that's
would
the difference between surviving and getting canned.
no, and I get you, and I'm following the logic there. But wouldn't you get out of that position before you took that entire 20% loss or 30% loss?
I'm saying that the put's going to offset that 30% and make it about a 20%.
Yeah, exactly.
So on the total, instead of getting a 30% loss on the correction, you're going to have a 20% loss. You're going to be able to survive. That's what it is.
But I'm trying to understand. Are you saying that you wouldn't close your long-term positions before you got to that point? You would just leave them open because you have the hedge, is what you're
Oh,
saying.
I see what you're saying. Okay, so in this scenario, we just leave everything open.
Okay.
Now, I'm going to tell you, if you see a bear trend, right,
Yeah.
start adding puts slowly. Write it down. Slowly, slowly start adding puts in a bear trend. So we can improve that, right? And also always be willing to close your weakest position. So always be willing to close your weakest position. So if it's losing, be willing to close it. If it's the weakest one, be willing to close it, start over, recap, reevaluate.
Yes.
And on a bear trend, slowly add puts. There's 2 pointers right there.
Perfect. Got him.
Now back to this hedge. You basically have 2 choices in the hedge. Okay, let's say that the put comes in, right? We have a correction, our technology went down, whatever the situation is. We can either sell the hedge at a profit, sell the put at a profit, or we can just keep it. Okay, because if it keeps going down, the put will keep coming in.
Mm-hmm.
But if we go back up and we return to a bull market, that profit you had is going to vanish in the put, and it's going to be like you didn't really benefit that much from it. It's like fire insurance, like it's there in case you need it, but you don't really want your house to burn down,
Yeah.
So back on the hedge, option 1, number 1, sell the put at a profit or leave it. Wait and see. Now, in the case of a 9-month, go ahead.
Uh-huh. No, so you're saying sell the put at a profit, but that would also mean that you would need to close that position so you're not losing if it went back up.
Wait a minute. When you sell the put at a profit, you take the profit. That it protected your account. What do you mean
Yes.
close the position?
So
What position?
let's just say hypothetically, I have SPY and I have those contracts that I'm losing on because they're calls and I'm losing, but I'm covered by the puts that I have. And at the time that I decide to take profit from the puts, I have to close my calls in order to not lose.
No,
No,
because you're determining that the market's going to turn and it should come back up.
I see what you're saying. Okay,
You try to wait till after the storm,
I got you. Okay,
and then now if you think it's still going down, then just keep it.
I got you.
Or if
Okay,
you don't know, listen. If you don't know for sure, just keep it.
got you. Okay,
The strategy between this is you don't have to close anything.
okay.
You want to keep your cover calls going. You want to keep even in a down market. Remember, I told you I traded Twitter. I wrote 71 cover calls on Twitter. Twitter went all the way from 50 to 13, back up to 50.
Yeah.
I wrote cover calls the whole way, 71 cover calls. Okay, so in theory, you want to keep your long positions going. Do close your weaker position. Do either close your put at a profit or just leave it because we don't know what the future is going to hold.
Understood.
Now, here's something that's important at the end of this. That 5% you used of your whole account
Mm-hmm.
to buy this put, I don't want you to think of it like you're just taking good money and you're buying insurance. That's not how I want you to think about it.
Okay.
The reason I use 5% is because we can get 5% on what? On the Tesla cover call, can't we? We can get 5% on DJT, Donald J. Trump
Yeah.
cover call, 10%. Can't we?
Yeah.
So let's just look at DJT. Can we look at DJT?
Sure.
So it's July. Okay. Look at the August monthly. What percent can we get on the cover call? Give me the stock price, and then let's find the sweet spot. Let's do a cover call position for the DJT right now. Firstly, what's the stock price?
34.98 was the close price.
Let's just say 35, close enough. And then let's look at what the 40 call pays for August. They're usually 5 points of share growth.
40. The call is you want the bid first is 3.15, and then the ask is 3.35.
What's the strike below 40?
Will be 39.
Since we get 3 points on the 40, look at the 39, because that way it'd be 4 points of share growth and 4 points of premium at the 39. What's 39 pay?
3.35 and 3.90.
That's a little closer. So you get 4 points of share growth, and you get 335 to 390. So here I want to put limit orders. See how it's a widespread?
Mm-hmm.
Write this down. Limits 350. If it's 335 to 390,
Yeah.
We already established we have a lot of volume on our stock.
Yeah.
So someone will buy that option and we'll take you out at 350. So DJT 39 cover call for August, 1 month out.
Yeah.
And we'll do this every month, right?
Yeah.
We talked about this. Okay.
Yeah.
So let's do the math. 350 divided by share price of 34.98. What's the percentage return? 3.55 divided by 34.98. ROI
350 divided by
0.98.
34.98.
ROI
So
return on investment.
that's a 10% return.
Okay, but give me all the numbers.
Yeah, it's 0.100005.
10%. Good. So here's what I'm saying. You're taking the cover call, a 10% cover call premium, and you're using that. We just earned that money. We're using that to buy our hedge. Okay. That's better than just taking money from our account and doing it. Does it make sense?
No, I got you. Yep.
You know what millionaires will do? And let's say they want a Ferrari, right?
Yep.
A stock trader, what stock trader will do, look at this DJT and say, well, my Ferrari's gonna cost me, let's say it costs me $1,000 a month, right?
Yeah.
So let me see, how many DJT do I need? 350, 3 contracts of DJT every month. So now we're gonna buy 300 shares.
Yeah.
That's $12,000. Can I get 300 shares for $12,000? But probably about 14,000.
Yeah.
They're gonna take $14,000, do 3 cover calls with DJT to get his red Ferrari.
And
Gonna make him $350, $700, $1,050.
Yeah.
And that's gonna pay for his Ferrari.
Yeah,
He's gonna, let's say he leases it, right? Or a sports car. It might be 2,000. I don't know what cars
sure.
are nowadays. But the point is, you're not just gonna take gobs of money and blow it like that. You're gonna make an investment to pay for your thing you want.
Smart.
To
Yep.
pay for the Ferrari, we're gonna need to run 3 contracts or more of DJT. To run our head, we're gonna need to have a nice cover call premium. We're gonna put that in our head.
Yep.
When I buy a house, let's say it's gonna cost me 3,000 a month. I'm gonna make an investment to pay for the house.
Yep.
I generally won't pay full cash for it. I generally want to make an investment to pay for it.
Yes.
And I don't want to listen. I don't want to reduce my cash reserves either,
Okay. How are you not
because
that?
that's going to take. I don't want to lose. I don't want to lose money on the whole. So if you're doing a trade to pay for the thing you want, then that essentially is already paid for. Makes
Yeah.
sense?
Oh, I see what you're saying with the put. That's why you're not losing your cash reserve.
Yes, you're not using your cash reserves. You're generating the money first and then putting it into your put.
No, I get you. So what happens, and this is like a similar situation to if you check your email, I just sent you the premiums that I collected as well as the cost basis for the position that I'm in. But for example, right now we're in this rotation and the stock, like I'm good on the cover call for right now. I'm a month out or a little less than a month at this point, but I'm losing money on the original cost basis, right? It hasn't come to a point where I've lost more than the premium I've collected, but it's eating into the premium.
Yeah, so you're doing some accounting in your head, and that's good. But remember, when we do the cover call strategy, think about in your head. You're doing 10 cover calls a year. Okay,
I see.
and we're doing DJT. We know we can get 350. That's really, and not it's not really $350. That's $3,500 for the year.
I see
Okay,
what you're saying.
so multiply by 10, and then think about the small money you're losing. Okay,
I see.
but also, let's say your stock comes down a little bit. Let's say you buy a stock at 35.
Yeah.
Let's say it goes down to 30. I still want you to write the lower cover call. Even though on
Okay.
paper you're going to lose the share growth, technically you're buying a stock and you're agreeing to sell it for 30. I'm sorry, you buy a stock for 35, you sell it for a few months down the line, the stock goes down, and you keep writing
Yes.
these cover calls. Even if you have to write the 30 cover call, that's good because you're getting what? Consistent monthly money. And the moment that stock goes down, you've already lost that money in the share growth. You can't say, "Oh, I don't want to lose money, so I don't want to sell it lower."
Mhm.
Not true. The moment the stock goes down, you've already lost the money.
Yes.
I want you to have that mentality. Um, I want you to do your accounting day to day. Okay. So if your stock is down, you've lost the money. Okay. So when
Hmm.
you do the cover call, you're climbing out of that hole. Okay. Remember the mutual fund manager. Okay. I want to talk about you have to be accountable every day. You can't be like, oh well, boss, we're down $1 million, but I didn't sell yet, so we haven't lost any money yet. Like, dude, your accounts are down; they're all in the red. We talking about having lost money. You can't convince your boss that's going to fire you is going to replace you with somebody else better.
Yeah.
So, I think what you're saying is, first of all, we had a tough week last week, right?
Yeah.
Because technology was getting hammered. The
Yeah.
Dow Jones was either creeping into new highs or look, it was down a lot on Friday.
Exactly.
And the technology is going to suffer because people are going to go into Coca-Cola, McDonald's, more safe stocks,
Yeah.
and then people are sell their Nvidia, they're going to sell their AMD, they're going to sell their Tesla because they want to be more certain, they want to be safe.
Yeah.
Those mutual fund managers are trying to trade. So our shares go down. I think what you were saying, your shares went down. Your cover call is helpful, but it's not giving you a gain in total.
Yes.
That will change.
Okay.
The more cover calls you do, the more premium you're gonna collect, and the more you're gonna be just all green.
Yeah.
Okay. And if we can get these trades working right, the trades are gonna benefit that even more.
Yeah. So
Push
I think it
calls.
was I collected 1,700 in premium on Tesla, and I'm down stock wise probably about $800-900 right now.
Well, that sounds like you have a gain on the whole.
Yeah, I'm still ahead for right now, but I'm just like you said doing the mental math, and I'm like, at what point do
Yeah,
you?
be prepared to make. So you made 1,700 on the cover call.
Yeah,
So be prepared to make another 17. Even if you make 1,500, be prepared to make another 1,700 and 1,500 for next month.
yeah,
And then you're just building. You're building your account. You're building cash. You're building. And
okay,
if stock is down, you're climbing out of that hole.
got you.
And if the stock gives you a 30% swing, or in the whole year, which it could do, you're just gonna take your 5% times, let's say 10, 50%.
Mhm.
If you have a 30% loss in the share growth, you have 50% gain in the cover calls that you still had a 20% gain.
I got you.
And that's 100% better than being a shareholder, having no cover calls, having a 30% loss,
Yeah,
on a bad year or a bad trend in the stock.
yeah,
Sometimes will have a great move in the stock, and you kind of wish that you haven't done a cover call because the stock will shoot up, and the option buyers will be happy, and the shareholders will be happy, and the cover call writers will be like, "Damn, I do a cover call."
yeah.
But I want you to just add 10 cover calls, and then ask the questions.
No, I get you.
because we're being consistent. We're getting consistent money
Yeah,
for what? So we can pay our bills,
yeah.
time to the cycle.
Yeah, it's just been for me personally, it's just been an adjustment being after being like doing day trading and then just seeing your stock down and you're like, oh well, it's okay because I got it covered by the cover call. So it's just I guess a mental adjustment of seeing your stock down, 10, 15% or whatever it may be, and know that you're still good because you collected that premium, but it's still down and it just looks weird in your account that you're not doing anything about it.
Are you having an epiphany?
Yeah, I got you.
Okay, question. We covered a lot.
No, I'm good there.
Okay, we talked about portfolio where one third, one third, one third.
Yeah.
I want to do a more aggressive strategy. Uh, 1/4 dividends, 50% cover calls, 1/4 trading.
Okay.
It's more aggressive because you're putting more, let's say, in the cover calls. Now, sometimes you can have a trader that's just really good at trading, and they got all their criteria and they got all their ingredients, like making a cake. You could put 50% towards trading. But
Yeah.
I would never put more than 50% towards trading, because you still want, even if on a bad trade, you still want to have your balance. You still want to control your drawdown. You still
Yes.
want to lessen your ability to lose. You still want to have a hedge. You know, so don't adjust it too much to where you're going to have a big loss.
Understood. And what do I consider my CDs that I have? I'm collecting 5.5% on my CDs, and that's where the bulk of my current assets are. So,
Well, let's say once you start doing 1, 2, 3, 4, 5, 6 months of consistent money in this cover calls, you might want to just
uh,
move over some of that money, you know,
okay,
make the money work for you, But it depends on how comfortable you feel.
sure.
The CDs technically are not even involved in this because you're doing that separate.
Yeah,
But if you move them over to what we're doing, you're going to either put them in dividends, cover calls, and trading, and then you're going to balance your account out like we're talking about. The
I
CDs
got
really is a separate investment. We don't really consider it because you're doing that on your own. You're getting about 5% a year.
you. Yeah,
is there a risk?
The US government collapsing.
I would say, I think about that time they had this empire called Rome.
Yeah.
One day it fell. Barbarians came in, they ravaged and pillaged the whole
Yeah.
city, and then I just think one day we're gonna be next.
Yeah, hopefully I'm turned into dust by then.
But I would say that your CDs are 100% safe, but you never know. You never know. You know, you always got to be prepared. Some people buy gold,
Yeah,
like gold coins or
yeah,
like gold
yeah,
bars,
yeah.
because you never know.
No, I get you. I just didn't know if CDs should be considered one of these four buckets, but
No, it's
sounds
just
like
separate.
no.
You can put that in a separate investment.
Okay.
We don't really count that. I'm showing you how to retire the stock market, so your CDs, just put that on the side.
Gotcha. Okay.
What you might want to do once you get more comfortable and you're stable, and after a certain amount of time, you might want to move some money over if get that money working for you. That's up to you.
Yeah, no, I get you.
Questions?
No.
Okay, we talked about the hedge, using cold call money to make a hedge to give you 9-month protection. Around the 7th to 8th month,
Okay.
I want you to close that 9-month put hedge and then open another one another
Okay.
9 months out or a year out. I never want to take options to expiration. Options are protection. I don't trade them to expire or to exercise.
Okay.
And at expiration, they're going to have no extrinsic value. They're going to decay at a faster rate at the
Yes.
expiration.
Yes.
So I always want to be able to get money back. Write this down. Always get money back on your options. Never let them go to zero. Write that down.
Yeah.
Curtis, a lot of people I talk to, business and seminars, the stock market, they all gonna have a story about how they lost all their money in options. Options went to zero. Don't do that.
Yeah.
Be a little smarter. Sell before. What I like to do, I take options at least 3 months out. I did that. At least 3 months out. I don't buy it for next week. I don't buy it just for the earnings. 3, 6, 9 year out on options, and then I generally sell them at least a month or sooner before the expiration. That way, there's always value there. So if you do an investment, regardless if it's a hedge, regardless if it's a small percentage of your account you're trading, you never want to let a $1 option go to zero or a 10-point option go to 1 point or zero.
Yeah.
You want to be able to get some money out, so close it. Either you're going to close it at profit,
Yeah.
like your plan, like plan your play, then play your plan. You have a win goal. You hit your win goal, pull the trigger, take the profit. If you have, let's say, you're in NVIDIA, if you got a scholarship from NVIDIA, let's say you put, let's say the option is 10 points, right?
Mm-hmm.
I'm going to pull the trigger at 15 points. I'm going to get 50% return. That's my plan. That's my win goal. Well, if that 15 hits, boom, I'm out. Okay.
Yeah.
But now my loss limit, now I don't want it to go, let's say, below 5 points. If it went below 5 points, something went wrong. I went the wrong way. That 5, if it goes from 10 to 5, my loss is going to pull the trigger. It's going to protect my loss. Now, if none of those happen and we get to this expiration, I'm also going to close it before expiration. Take what I can get back, and then if I want to keep playing the video, open it again in the future. I roll it forward.
Yes.
So that's the way I do trading options.
Understood.
That way, it'll keep you out of trouble. It'll keep you from losing all your money. Going totally broke. Like think about like gambling. Like people go to Vegas, they go in with X dollars. And what happens? What happens usually? When do they leave?
They leave with nothing.
Zero.
Yeah.
like I got wiped out. So
Yeah.
even if most people, even if they win money, 100,000, 2,000, they get all happy. What do?
They go back in and say, I
They
can.
go. They keep playing. They keep playing.
Yeah.
Until what?
Until that's gone.
Eventually they lose it.
Yeah.
So if you look at Vegas as a business, um, they don't make money because they have a 5% advantage or a 3% advantage on the game there. They make money because people are stupid with the managing the money.
Yeah.
They make money because they're gonna win. Let's say 97. Let's say they have a 3% vig for the house or 5%, whatever the game is, right?
Yeah.
Even on poker, they might put money in the pot.
Yep. Yep.
They take a percentage, whatever. Um, that's not really the profit they make. They make profit because people keep playing until they lose everything.
Yeah.
Think like that. Like when you're doing the stocks, don't be that guy. Be the house.
Yep.
Okay. Be smart. Protect your money. You're not a novice. You're not a random bad gambler. You have ingredients. You have knowledge. You want to apply these skills. You want to apply these principles to make money consistently. You protect your downside with a win goal loss limit. You protect your downside, your drawdown with a hedge. If the market corrects 30%, you're only going to lose about 20%, maybe less, and maybe even less if you can see the trend.
Yeah.
And you're not going to get fired as a money manager. You're not going to blow your whole account and be the guy that said, "I lost all my money in call options."
No.
And you're going to make consistent monthly money, if not even in trading. Forget the dividends. Focus on the cover calls.
Yeah.
That's enough to retire you in the stock market.
Yeah. No, it makes a lot of sense, and some light bulbs are continuing to go off.
Now, do you have a dollar amount you like to make per month?
Yeah, based off of my budget, I would probably say about $5 grand a month.
$5 grand?
Yeah.
Okay, I want to use that number for you.
Okay.
Let's do some basic math. I think we can probably wrap up pretty soon.
Okay.
Just basic math, $5,000 a month, right?
Yeah.
In a general sense, it's easy to get through a 3.3% return on cover calls. Okay.
Okay.
We know the DJT pays 10%. We're not going to put all the money in that. We know Tesla pays what, like 5 or 6.
Yeah.
So 3.3 is like you can have a couple of dividends. You can have some other positions. You still get 3.3 average, right?
Yeah.
A month. So how much investment do you need at 3.3% return? Let's just say mostly from cover calls to get your $5,000 a month.
So help me with the math.
Well, it's the division. You take one divided by the other, and that'll give you your dollar amount.
Okay.
You can take the 5,000
Divided by
divided
the
by the other,
3%.
it'll give you a dollar amount. The amount's gonna be like
45.
Huh?
46K a month, or
No, that's not right.
no? Say that
Maybe
again.
divide the other way.
So 3.3.
Oh, wait, okay. Let's stop right there. It's not 3.3. It's 3.3%. So you're gonna go 0.033%.
Yeah, I convert it. I got you. I'm doing that. 3.3% divided by 5,000. So is that right? It says 151,000.
That sounds correct. So 150K at 3.3% return per month on cover calls. So we get you 5K
Okay.
a month. That's your goal right now. That's a real basic goal.
Okay.
We're gonna improve that over the sessions. But on paper,
Yeah.
you say you have the video?
Yeah.
Let's look at the video cover call for next month, can we?
Okay. Can we look at the one that exactly that I have? I just sent that to you. I don't know if you have access to your email.
Can you show your screen? Or you know what? Why don't you just tell me about it?
Okay.
So what strike do you have?
1 second, let me pull it up. So NVIDIA, this Tesla. NVIDIA is the 122 call.
Okay. Is it
Expir
August
expiration is August 16th.
monthly? Okay. And
Yeah.
then give me the close for the video and the change
The close for NVIDIA.
on Friday.
Yeah.
Price and the change for the day.
So the close for NVIDIA was 117.2 or 0.93.
Down what?
And it's down 3.16%.
And you wrote the 122 call?
Yes.
And how much did you get for the 122 call?
122 call. The premium was $600.
$600 even?
Yeah. Well, it was 599.32.
Close enough, $600. So do you remember what you bought the stock at?
I bought it at 121.08.
Let me guess. The shares went down and then you did a cover call, right?
Yeah, that probably happened.
So that's kind of a slip up on our part
Okay.
because if the stock's at 121 and you're getting
No,
6
I
more,
bought them at the same time.
you bought it and wrote it.
Yeah.
So my question would be why you didn't write a higher cover call. You bought it at 121 and wrote the cover call.
Yeah.
By the way, did you buy the shares and do the cover call in one trade?
Yes.
I don't want you to do that.
Okay.
I want you to do manual. I want you to buy the shares manually,
Okay.
and there's a reason for this. Just trust me. Okay?
Sure.
And then after that, look at the cover call,
Uh-huh.
and then you can put limit order. You can wait. You can do a higher lower one, but you're evaluating. You're always evaluating, okay, or reevaluating. Okay?
Yeah.
And then what you're probably would have done is a sweet spot, which is to say that if you're getting if you can get 6 points for the 122, you're only getting 92 cents share growth. Follow me?
Mm-hmm.
So you're agreeing to sell the stock at 122, okay? But it's only giving you 92% share growth. I would say that share growth is a little bit less than we would like.
Yes.
I would have done maybe like the 124 or the 125, and then you would have got maybe $500 or $400 less. You would have got
Yeah.
like $500 for the premium instead of $600 or $400. But the theory is that you want to allow both share growth and premium. Okay.
Yeah. I think I was looking at the premium only at that point in time, and that's where I made the mistake.
It's a little slip, but it's not necessarily a mistake, but I want to improve. I want you to improve that because
Yeah.
over time, you'll see the videos going to go up
Yeah.
and you're going to get share growth and premium, both, not just the premium.
Yeah.
Now, let me say this.
Okay.
If we're down next couple months,
Yeah.
then you did better because you got more premium.
Exactly what I was going to say.
And it's already going down. So it's
Yeah,
like
my thought process was that we were rotating out of this stock, so I figured it was going to go down. So I said, let me take the higher premium because it's very likely it's going to drop before.
So in that case, you did good, but I want you to always consider the sweet spot, which is
Okay.
the distance between the share price and the strike you're going to write is what we call share growth potential, SGP, share growth potential, equal to the premium, and that's the sweet spot, SS sweet spot.
Okay.
But
Say that one more time. You say a share growth minus.
the share growth potential, the
Okay.
distance between the share price and the strike you're going to write
Okay.
is equal to the premium.
Is equal to.
That's a sweet spot. So if you have 121, okay, and you can get, let's say, 4 points right in 125, then you write the 125.
Gotcha.
Because it's 4 points between 121 and the strike at 125. That's 4
Yeah.
points of fair growth, and then the premium is 4 points. You see.
I got
So when
you.
you did, first of all, you did the trade in one trade. I want to do that. I want to do
Yeah.
separate manual trades.
Yeah.
Buy 100 shares first, hold that, and then see what cover call you want to write. And one advantage you're going to get, especially on these high volume stocks, that you can do a limit order. If the spread is, is 550 by 6, I want you to limit 575. I want you to fight for the extra quarter.
Okay.
And if you wait 10 minutes, it'll
Yeah.
probably be picked up. At a high volume, it'll probably be picked up.
Yeah.
A
So
quarter
don't
is
get in a rush.
$25.
Yeah.
And if you're doing multiple contracts, that's
Yeah.
gonna pay for my lunch.
No, I get you. Sometimes when I was like, just let's get in it now so I could be done with get in this position. But you say those points make a difference, so definitely.
Yes. And I want to say something. What you did is not bad, but I want to improve it. Okay. Now, what the millionaires will do to be safe, to do a safe trade, is they'll actually do a cover call in the money. Okay.
Yes.
Now let's do the math on your trade. If you bought the shares at 121 and you're getting $600, let's say a month, right?
Yes.
But in this trade, it's $600. Your break even is what price on the video?
Break even would be this is including the premium,
Yes.
so it'd be 12. What would it be?
It'd be
12.
120. It'd be 121 minus $600.
It would be minus $600.
Yeah, 121 share price
Yeah.
minus $600 is what?
So it's 479.
Yeah. 14. 114.79. Is that right? Because if the stock goes down to, I would just say 115. Okay.
Okay.
You got 6 points for the premium. This is how I do it. You got 6 points for the premium. You bought the shares for 121.
Yes.
So your break even is 115.
Yes.
That's what I'm saying. So if the video goes down to 115, you're a wash. Okay.
Yes.
If it's above 115, you're in profit mode.
Yes.
That's for month one. Okay. Month two, you're gonna have, let's say you do another $600 or $500. You're gonna have 11 points to protect you from, right? So when I say what's your break even, like if the video is anywhere between 115 to 121, you're in profit mode. But if it's below 115, then you start going into an overall loss.
But that's 817.
Questions?
No, I'm looking at the analysis tool that they have on Thinkorswim, and you're spot on. It's 115.05 is my break even at the end of this contract.
So what the millionaires will do, Curtis,
Yeah.
is they're gonna take the video, they're gonna go in the money. Okay. And I'm gonna tell you why. Okay.
Okay.
This is a safe trade. You're gonna get less return. That's gonna protect your money. This is what we're gonna do. Okay. Let's say we go to, now let me ask you a question. We're having a bumpy market. What price do you think the video can go down to if it goes down?
If it goes down
lower than what it is now. Give me a number lower than what it is now. Yeah.
I would have to look at the charts and see where.
No, just give me a like 2-second answer.
I would say probably $100 at worst.
$100 at the worst.
Yeah, but I haven't looked at any analysis on the charts.
Okay, so let's do the $100. Let's do the $100 deep in the money cover call. $100 CC for August.
Okay.
Okay. Now, how much is it paying? $100 strike for August.
Yeah, let me look. For August, $100 strike. So it's 19 18.80 is the ask and 19.55 is the bid.
Let's say 19.8. Let's say 1980. Okay.
Yeah.
Now we buy the shares here. So you buy the shares here at 17.93, 117.93. Okay.
Mhm.
Now you're gonna get 1980 for doing the 100 strike. Okay.
Yep.
So what this means is you agree to sell the shares at $100. You buy them here at 117. We issue the shares at $100, which means we're gonna have a 17.93 loss. Okay.
Yes.
Automatically. Okay. So write that down. 17.93 loss points. That's $1,793 loss in the share.
Yes.
But we're gonna get a 1980 gain on the premium.
Yes.
So what's 1980 minus 1793? Do the math on that.
1.87.
1.87. That's $187 they're gonna make from that trade. Now, why is this a good trade? Why is this a safe trade? Because per contract, they're gonna bring $187 gain. Okay.
Mm-hmm.
Well, it's not a lot of money. Guess what? They're protected. If the video goes all the way down to 100, they're safe. They're protected. They're good.
Sure.
So what they do, they're reducing their chances of losing. Just like I said, remember the mutual fund manager. You reduce your chances of losing. You're gonna pull out a small gain, but the chance that you're losing, it's almost like those CDs you have.
Yeah.
You know, you're gonna get $187, which is it's a small percentage, but it's real money.
Yeah.
Okay. And you agree to sell it 100, and no matter what it goes down to, even if it goes up, you're still gonna get the $187.
Yeah.
So that's what you call a safe trade. You reduce your chances of losing, a deep in the money cover call.
Excellent.
I'll show you that.
Yeah, I'm looking forward to reviewing this session to go back and get that crystal clear.
I mean, look, Curtis, I'm gonna show you some trades that give you a high chance of winning. Okay.
Mm-hmm.
Let's put to the extreme. Let's say you're investing Fat Tony's money.
Yeah.
And you need money, he's gonna break your leg.
Yeah.
You're looking at ways to win.
Yeah.
You're not trying to do a risky trade.
Yeah.
See? So everything is here for you. You just have to pick the right trade for you.
Yep. No, this is good. Like I said, I'm seeing the logic and methodology here. I just got to crystallize it in my head so I can do it on my own without going back. That'll take some practice, but I'll get there.
Can we close it on a positive note?
Sure can.
All right. Let's wrap up. Rewrite your notes. I will send you the recording.
Yep.
Download it for your records. Rewrite your notes, and we'll be back next Saturday.
Excellent. I'll do definitely.
Come back with questions.
Yep.
Thank you, sir.
Hey, I appreciate your time. Thank you.
You're welcome. Have a good day.
All right, you too now. Take care.